DraftKings stock is down close to 50% from its year-to-date highs, but despite the drop, I think the market is still underestimating how big this company could become. And to show you why, I built a 10-year forecast for revenue and free cash flow, and my fair value comes in at around $41 per share, suggesting that the stock could be about 30% undervalued, also implying an estimated annual return of around 18%. In this video, I'll break down what makes DraftKings such an exciting growth story and go through both the bull and bear case to see if it deserves a place in your portfolio. So yeah, let's jump in. And before we jump into the details, let's take a quick look at how DraftKings has performed over the past fiscal year, which of course was 2024. Now revenue grew by 30%, that's great growth, but at the same time EBITDA was still negative, however less negative than in 2023, resulting in a negative EBITDA margin of -5%. Now the current share price is around $29, that's down 22% over the past year, and the company is of course headquartered in Boston in the United States. Now DraftKings isn't just another tech or gaming company, it's a digital first leader in sports betting and online fantasy sports. The company has built a platform that not only lets users bet on sports, but also provides a full entertainment ecosystem, keeping players engaged. Active users are rising rapidly, and DraftKings has been expanding into new states in the US. And to better highlight how big DraftKings actually is in the US, here's a quick video quiz. So roughly what percentage of the US online sports betting market do you believe that DraftKings control? Is it A, 30%? Is it B, 15%? Or is it C, 5%? And the right answer is 30%, which is a really high percentage, but still has plenty of room to grow in the coming years. However, it's not just about growth. DraftKings is moving toward profitability, margins are improving as revenue scales, marketing efficiency increases, and high margin iGaming revenue becomes a larger part of the mix. Now, while losses still exist, the path toward free cash flow is more clear. Now, with that said, the bull case is quite clear in my opinion. First, you have market leadership. DraftKings is the US market leader in sports betting, with strong brand recognition and broad user base. We also have regulatory tailwinds. As more US states legalize sports betting, DraftKings stand to benefit from a growing addressable market. And finally, we have a path towards profitability. Increasing operational efficiency could turn DraftKings into a free cash flow generating machine. Now, it's not all perfect, right? We have a bear case as well. For instance, we have competition and pricing pressure. Other entrants are aggressive, which could limit DraftKings market share in the future. And finally, we have uncertainty regarding profitability, and reaching sustainable free cash flow depends on execution. Okay, so now I have a sense what makes DraftKings such a unique company. Now let's take a look at some historical financial data that we'll use as inspiration later on in the valuation. Here we have data going back all the way to 2020, and you can see revenue in blue and EBITDA in green. Now the important takeaway is that revenue has grown by 67% per year on average over the past 5 years, which is really impressive. Now EBITDA has been negative for all of these years, but it's improving, right? It was negative 124% in 2020, and today it's negative 5%, and it's also forecasted to turn positive in 2025. Now I also like to take a look at the debt sustainability in the stocks that I analyze to see if that is any risk for us as investors. Now here you can see debt in purple, and we can also see the excess cash in green. Now it's really important for investors to take note that the excess cash is going down in the company at the same time as the debt is remaining flat. So it's really important for us as investors to keep an eye on the debt in the company in the coming years depending on how they execute. Now, as we later on will use the free cash flow in the valuation part, let's also take a look at the free cash flow performance. Now here we can see again revenue in blue, and instead of EBITDA we can see the free cash flow to equity, so that's the relevant free cash flow for us as investors in green. Now we can see that free cash flow has been all over the place, but the good news is that the company had a positive free cash flow margin in 2024. Now, if the company continues to execute, this free cash flow margin will expand rapidly in the coming years, hopefully for investors. Now, the final chart I had to show you has to do with the share performance of the company. First, we can see the share price of the stock as the green dotted line, and we can also see the shares outstanding in millions as the blue columns within the company. Now, we can see that the share price is still well below where it was in 2020. That's good news for new investors. However, what's really tricky is the share dilution. For instance, we can see that the shares outstanding has grown by 5% on average per year, diluting existing shareholders. Now, hopefully, if the company becomes much more profitable in the future, the share dilution will decelerate, as 5% share dilution, in my opinion, is not sustainable for a company in the long term. Okay, so now we have taken a closer look at DraftKings' historical financial performance. Now let's move on to the exciting part, which of course is the valuation part. And I'll start off by showing you all of my assumptions that have gone into my bull case valuation, so you know exactly what I'm assuming in my valuation. And all of these assumptions go all the way up to 2034, so 10 years in total. And let's start off with revenue growth. Here I'm assuming 16% per year. That's of course much lower than the 67% we've seen over the past 5 years. But then the revenue base was much smaller, so it makes sense that revenue growth will decelerate, right? Now in terms of EBITDA margin, here I'm assuming 18%. That's much better than the minus 63% we've seen in the past 5 years. And that's what's driving this valuation, that the company actually can become profitable in the coming 10 years. Now, in terms of enterprise value to EBITDA multiple, I'm assuming 12 times. We've seen in the past 5 years 29 times on average. So assuming that the multiple will compress. Now, in terms of free cash flow growth, here I'm assuming 27% per year. This is also what's driving this bull case valuation, that the company will become much more profitable in the coming years. Now, in terms of the free cash flow yield, that's the percentage of free cash flow we get in the future relative to the share price. I'm assuming 6%. And finally, I'm using a discount rate of 12.2% when discounting the future free cash flows of DraftKings into a present value of today. And yeah, here you can see a summary of the growth rates for revenue and free cash flow that I'm forecasting. Now, the revenue growth in 2025 is basically in line with the company's guidance. And you can also see that the growth rates for free cash flow will be quite high, right, in the first years. And then basically I'm decelerating these growth rates all the way down to 10% each, right, in 2033, staying flat at 10% for the 2 final years in my forecast. But now you might ask, how could a company like DraftKings increase free cash flow by 85%? Well, 85% isn't that huge given the small base of free cash flow the company has today. So growing by 85% increases the free cash flow margin only from 6% in 2024 to 8.5% in 2025. And if we discount all the future free cash flows in the forecast to a present value of today, we get a fair share price for DraftKings at around $41.6 per share. This also implies that the stock could be around 30% undervalued, and that the stock could also give us as investors an annual compound return at around 18% per year. Now here you can see how it could potentially pan out for us as investors if the company performs in line with our bullish estimate. Now of course we have to invest in the stock today, that's negative cash flow for us as investors. Then we get free cash flow distributed to us as dividends or buybacks, and then finally we sell the stock in 2034. So the 18% per year is basically the total gains relative to our initial investment in 2025. Now as a new segment in my evaluation videos, I'm comparing DraftKings to its closest competitors that you as an investor could invest in. In this case I've chosen MGM Resorts and Penn Entertainment, and here I'm comparing them across 4 metrics. Now starting with enterprise value to EBITDA, we can see that Penn Entertainment is the best option. However, at debt to EBITDA, I believe that DraftKings is the best option. If we compare to MGM and Penn, we can see quite high levels of debt. Now in terms of EBITDA margin, we can see MGM is the best option, and also that's the case when it comes to free cash flow margin. But the whole investment thesis in terms of DraftKings is that you can invest in a company, and then in the future as the company executes, we'll see positive EBITDA margin and free cash flow margin. So it's basically a turnaround story that you as an investor need to believe in order to invest in a company long term. Now, regardless of how bullish you might be around DraftKings as a stock, there is always a bear case if the company does not execute at the level that we are forecasting in our valuation. So let's take a look and see where the fair share price then lands in our bear case. In this case, I'm assuming revenue growth at only 8% and free cash flow growth at only 9% per year. Now, if that's the case, we get a new fair share price at around $11.5 per share. This also means that the annual return then drops to a negative 1% per year. So basically it all depends on where you as an investor believe that DraftKings could perform, right? If the company does not execute in line with those estimates, there is a risk that you as an investor could long-term lose money in this stock if you decide to invest today. Now let's also take a quick look and see how DraftKings compare to other stocks I've talked about in my channel in terms of investment positioning. Now here you can see all the stocks that are undervalued at the top and the stocks with great businesses as well to the right. So we want stocks that are up to the right in this investment positioning landscape. Now with that said, I'd actually placed DraftKings over here, right? It's definitely a stock I believe is undervalued right now. The question is the quality of the business. If the company can turn around and become extremely profitable in the future, and then of course it will move to the right in this matrix as it becomes a much higher quality business for us as investors. Now, what makes a great stock, in my opinion, isn't only that it's a great business and that the stock is well priced in the market right now, it needs a third element as well that I call momentum. So let's take a closer look at DraftKings to see if the stock has any technical momentum right now. Now here you can see a stock chart of DraftKings ever since its IPO a few years back. Now it has regained some of that momentum right in the past few years as the stock price has rebounded and regained a lot of the previous drop we saw a few years ago for the stock. Now, if we zoom in a bit, we can see that the stock price is in a tricky position right now. We've seen in the past few years that the stock has had some strong momentum. Now we can see just in the past few weeks that the stock has broken below right. Now, if you are bullish around DraftKings, this might be a great price to start nibbling at a few shares in your portfolio. Now, if you'd like to wait and see what happens, another good entry point might be when the stock breaks above the 200-day moving average again and regains some of that lost momentum. But then, of course, you run the risk at buying the stock at a much higher price. Now, if you are interested in investing in DraftKings but would wait for a better price, this table below shows you what happens to the annual expected compound return if the stock price goes down. That's good for us as new investors. Now, if the share price would decline by around 20%, then we could get above 20% annual compound returns. Now, if the stock would, for instance, go up by 20%, then we can see that the expected annual return drops down to 15% per year. So it all depends on where you, as an investor, feel comfortable entering DraftKings to hold the stock long term. Now, given the discount that the stock is trading at today, I've given the company a buy rating and 4 out of 5 stars as my final rating. And yeah, here you can see all the key considerations that have gone into my final rating of DraftKings. We can see that the stock has scored really well in terms of revenue growth. In addition, the valuation is really attractive in my opinion, and the stock has a strong competitive positioning compared to its competitors in the segment. Now, where the stock hasn't scored that well, of course, has to do with its historical EBITDA and free cash flow performance. It has been negative for a few years, right, at least for EBITDA, and also in terms of low legal and macro risks. This is a company that's heavily reliant on US regulation, so that's also something to keep in mind of as an investor. However, if you believe in DraftKings and their growth story, this could be an amazing opportunity to invest and hold the shares for the long term. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. So yeah, thank you, and I'll see you in the next one.